Good morning. It's Tuesday, the 17th of September, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. And today is Ganpati Visarjan, the day most of us take a half day, or if not stay away, or rather stay at home completely. The take. What should you do now? Asked a financial newspaper last evening. It seemed like the end of the world was almost here, and you had to make some tough choices about life and, of course, investing. Given the euphoria that drove the Bajaj Housing Finance initial public offer and the subsequent listing bump, perhaps the question was a little accurate in its framing. What indeed would you do now? So why are people asking this question? Well, it's because the stock listed at a premium of 114% yesterday and then rose another 10%. It's perhaps the biggest existential question recent trading days. Should one invest now or not? More on that soon. But just to track back a little, Bajaj Housing Finance, a subsidiary of Bajaj Finance, came out with a roughly 6,500 crore public issue and was subscribed nearly 64 times, or rather oversubscribed nearly 64 times in 3 days. Now that amount added up to 320,000 crore rupees. So what does this company whose stock is so valuable do? Well, it provides home loans, loans against property, lease rental discounting, and developer financing. Remember another well-known non-bank finance company did the same thing, at least roughly? Well, that was HDFC, which then merged with HDFC Bank in July last year because it's more efficient to be a bank than a non-bank finance company in this housing business. Because among other things, banks can access lower cost funds than non-bank finance companies, and mostly that's through deposits from people like you and me. Which is not to say that there is no market opportunity, but there is nothing so rocket scientist-ish in this business, except of course for the strong track record and the Bajaj brand name. But even other analysts are saying that there are better bets in the market. A veteran investor told the Economic Times that apart from the rate of loan and quality of service, housing finance is a commoditized business. So he says he would rather buy other housing finance companies like PNB Housing, LIC Housing, rather than try to buy Bajaj now. If you're lucky enough to have gotten the IPO, then I would be a seller on listing, the investor who's called Chakri Lokapriya said. Another said that conservative investors should sell as the listing gain was over and above expectations. He did say that long-term investors could continue holding for long-term growth as the sector outlook remains very optimistic given the company's well-positioned business model. Of course, the question is whether investors are paying any attention to the details because most of them are seeming to be asking that one question, should I jump right now or rather sell right now? He did say that long-term investors should continue holding for long-term growth as the sector outlook remains very optimistic given the company's well-positioned business model. Of course, that statement might sound a little unusual to investors who, of course, have never held shares beyond the first few days or even the first week of listing. So the other question, of course, is whether investors pay any attention to the details or jump blindly onto every IPO that hits the market. Remember, the IPO of a two-wheeler showroom was oversubscribed about 400 times. Then what is 64 times in contrast, you might ask, though the amounts, to be fair, were vastly different. Such euphoria is precisely the green light that companies have been waiting for, including those who I am sure did not have such near-term fundraising plans. More and more large-cap IPOs are also lining up. The latest news is that LG Electronics is looking to IPO its India arm on the heels of another Korean giant, Hyundai. Together, they could IPO almost $4 billion in the next year. These are companies who've been in India for several years and run mostly profitable businesses. And no one ever thought, at least I didn't, that they would IPO in India. Because remember, it's rare to see multinationals list in India, at least in recent decades. Jumping onto the bandwagon are obviously the tech IPOs, which are mostly loss-making but will ride the frenzy nevertheless, and thus provide far quicker exits for their investors and founders than surely they would have imagined. Where does this all leave the smaller Indian investors who are rushing in today is a little difficult to say right now. Most are betting on short-term returns, but you have to remember that not all get allotments, and those who do will not succeed every time. At some point, the musical chairs slow down, particularly when stocks of them start quoting below water after a year, as many previous IPOs are. It's of course tough to predict the turning point, as I would happily confess. One indication of its arrival, of course, is when investors start moping about a lost IPO and wondering if they will ever get such an opportunity again. Which brings us to the top stories and themes. The stock markets are back to hitting fresh record highs. Is the Bajaj Housing IPO the last best opportunity there ever was to make money? The government sharply hikes import duties on imported palm oil, a move that's bound to hit consumers but help farmers. Why opportunities for generating renewable energy in India are lesser than you might think.
This is the Core Report with Govindraj Ethiraj.
The markets resumed their run. Well, the stock markets were up again on Monday, though somewhat slowly. The 30 stock Sensex was up about 98 points to close at 82,988, while the NSE Nifty 50 was up 27 points at 25,383 and hit an all-time high of 25,445 during intraday trade on Monday. The stock price of Bajaj Housing Finance was up about 135% from its IPO issue price of 70 rupees to hit the upper circuit of 135 rupees on the Bombay Stock Exchange. The stock listed at a premium of about 114% at 150 rupees on the BSE today. Elsewhere, the NSE Midcap100 index scaled an all-time high of 60,408 before its record high close of 60,259. Oil prices are steady. Oil prices have steadied now around $72 a barrel after rising slightly over the weekend as traders contrasted a drop in Libyan oil exports against signs that an economic slowdown in China is deepening, as we've been reporting in recent weeks. Brent futures were trading around $72 a barrel, as we said, while West Texas Intermediate was around $69, according to Bloomberg. Libyan exports have declined markedly as a United Nations-led talks failed to break an impasse over control of the central bank, which has spilled over onto its oil industry. All of this is obviously affecting oil prices in the world. Chinese data over the weekend showed industrial output in the longest slowing streak since 2021 and investment falling more than expected, with the official economic growth goal of 5% for this year now looking increasingly out of reach, said Bloomberg, adding that China, of course, is the world's largest crude importer and the slowing economy has pushed Brent crude prices down about 17% this quarter, and that being the lowest since late 2021. Was this the last money-making IPO? Well, back to Bajaj Finance. It joined the 100,000 crore rupee or 1 trillion rupee market capitalization club, crossing 100,000 crores to close at about 137,000 crore rupees, according to data from the National Stock Exchange, quoted by NDTV Profit. So how should investors read this blockbuster opening in the context of the company in specific and the markets in general? Remember, we've been talking about this as a euphoria. I reached out to Narendra Solanki, Head of Fundamental Research at Anand Rathi Investment Services, and I began by asking him whether this was indeed an outlier.
It's a combination of both. Definitely, the IPO markets, or so to say, primary markets are euphoric, and the sentiments are very good right now, as we have seen in past IPOs. Plus, if you see about the Bajaj Housing Finance IPO, so the company has a tremendous good track record in terms of its performance, execution, as well as the kind of management team it is having, the kind of balance sheet it is having, return ratios. You talk about net NPAs, which are lowest in the industry. You talk about ROAs, ROEs. So everything is very good as far as financials are concerned and track record execution is concerned. And the market it is operating in, which is the housing finance, which is considered as one of the best lending book business in terms of overall lending business. So combining all these factors, the IPO has garnered a tremendous response from all the different categories of participants, be it institutional, be it retailing, be it HNIs. And hence, we have seen the kind of response what we have seen.
Okay. So the next question obviously is the value. So one view is that it's already at a price to book multiple of 6x, which doesn't leave much scope for potential, at least as things appear. The second, of course, is that it listed at 114% premium and then went up further after that. So the real question is not whether the business is good, which it is. The company is good. It has strong backing, brand, and execution history. But whether this is the price that one should pay and whether this could last.
Definitely, post listing, the price to multiples have re-rated and it is now somewhere between 6.2 to 6.5. And maybe it can increase further because today was the first day and we have to see from next few days where the price settles. So maybe it would settle around somewhere these lines, maybe plus minus a few percentage points more. In terms of valuation, the fact with the valuation is that yes, definitely you are paying a premium for a good business, but you have to see what kind of a growth and what kind of return ratios you are getting or you may be getting in the future. So right now, if you talk about the ROAs currently are just shade below 2%. I think 1.8, 1.9% in the ROAs, and just shade below to 12% in the ROEs. For the next 2 years, I think there's no doubt about who would be going. But definitely in terms of valuation, so if you are buying a stock which is trading at a significant premium to its peers, then you must have a long holding period scenario in your mind. So it's not if you're buying it in Bajaj Housing Finance right now, so you must have a long horizon holding period to keep in your mind.
Right. And which brings me to a slightly larger question. I mean, you also said that, there's a lot of IPOs which are still lined up. And every week we are seeing at least one perhaps big IPO. How should investors look at this? I mean, because there's a little bit of history now. I mean, we've already seen so many months of active IPO markets, including in the SME IPO market. We've seen some real wild cases. And as more and more money is collected from the IPO market, presumably investor appetite also goes down to some extent.
I think IPO, or to say primary market in India, is going to flourish, and it is having a very huge demand. If you see the net mutual fund inflows month over month data, so we are getting a significant secondary market inflow. So it is good that a lot of IPOs are coming, so they are absorbing the net inflows, and we are not seeing so much of high multiples in the secondary market. But yeah, there are definitely a lot of good IPOs coming, and in between, there may be some IPOs which may not be worth investing. So what you have to do is you have to look at stock specific, business specific opportunities. You definitely don't have to sideline the valuations just because everybody is go about the IPO market. So definitely business matters, fundamental matters, balance sheet, profit and loss, overall business quality, and valuations does matter both in the short term as well as in long term. So every IPO, one must definitely do a due diligence before trying to invest, either for a short term or for a long term perspective.
So most investors actually don't do all of this. And despite you saying it or I saying it, I mean, eventually, I guess most people will just hit the swipe button on their smartphone and buy it through a stockbroking app. But my question really is, if there were just one or two things that you feel investors should, focus on, even those who are impatient and so on, what would those one or two things be, at least in the light of the IPOs that you've seen in the last, or at least in this bull run?
So I would like to see that when valuations are rich, or when valuations get rich after listing. So definitely you have to keep in mind that your return or your holding period is going to increase because markets are not linear. Right now, it may rise for next 3 months, 2 months, 1 month, but there's going to be a period when you have to see underperformance. So whenever valuations are rich, you have to keep in back of mind that at any given point in time, my holding period might increase in that stock. Second point is, I would like to say that if you're investing in a company which is currently loss making, then definitely the business may be good and the company may perform very well. But since it's a loss making, it does take a lot of time to turn around a business and to scale up the business. Like in the case of some new tech companies which are coming on the IPO. So it might be a good investment, but you have to keep in mind that your holding period is going to increase to see their business to its natural future. So that two, three things you have to keep in mind. And if valuations are decent and the business are decent, then clearly going for the IPO.
Right, Narendra, thank you so much for joining me.
Yeah, thank you.
India lends a helping hand to farmers. India has opened up exports further of agricultural products. Remember, we spoke of basmati rice floor price being removed, and now it's more commodities, including onions, which can be exported freely and with a lower export tax of 20% versus 40% earlier. That's onions we're speaking of. Moreover, the government has also limited, somewhat surprisingly, the imports of vegetable oils. And that move surprised the market, as the government usually looks out for consumers first, particularly during the festival season, which has just kicked off. However, this year it prioritized supporting farmers, setting aside inflationary concerns, according to Reuters. India is the world's biggest edible oil importer and has now put a 20% basic customs duty on key edible oils. So effective import duty on crude palm oil, crude soy oil, and crude sun oil rose 27.5% from 5.5% earlier. And they're also subject to an agricultural infrastructure and development cess as well as a social welfare surcharge. The import tax on refined palm oil, refined soy oil, and refined sunflower oil is up to about 36% from about 14%. India imports about 70% of its vegetable oil needs, and palm oil in turn represents about 50% of total imports. The big renewable energy charge. Reliance and Adani, among other firms, have committed to help India reach its goal of 500 gigawatts of clean energy by 2030, while financial companies have promised about $386 billion in funding, according to India's Renewable Energy Minister, who spoke on Monday at the annual Renewable Energy Investors Meet and Expo in Gujarat. India added about 18 gigawatts of renewable energy capacity in the last year compared to about 15 gigawatts a year earlier, which takes its total, that's India's total, to about 153 gigawatts, according to Reuters. The government also received an additional 570 gigawatts of power generation commitments, while manufacturers committed additional capacities of 340 gigawatts in solar modules and 250 gigawatts in solar cells, according to the minister. Interestingly, while India has a renewable energy potential of over 24,000 gigawatts, even reaching 7,000 gigawatts required to achieve net zero emissions by 2070 will require a holistic approach to addressing challenges such as land access, climate risks, land conflicts, and population density, according to a new independent study by the Council on Energy, Environment and Water, or CEEW. According to the CEEW, up to 1,500 gigawatts, the constraints are relatively manageable, but after that, it gets tougher as multiple constraints intensify. And that's the key finding in the study titled Unlocking India's Renewable Energy and Green Hydrogen Potential, an assessment of land, water, and climate nexus. The report says that deployment beyond 1,500 gigawatts could face critical challenges as renewable energy, including solar, wind, and green hydrogen, is crucial to realize India's climate goals. But scaling up these technologies will also require strategic land use, improved water management, and resilient power grid infrastructure. The CEEW study maps India's renewable energy and green hydrogen potential by looking at the country's landmass and applying real-world constraints. For example, it finds that population density significantly limits the realization of India's renewable energy potential, with only about 29% of onshore wind potential and 27% of solar potential located in areas with a population density lower than 250 people per kilometer. Land conflicts further restrict deployment, with only about 35% of onshore wind potential and 41% of solar potential located in areas free from historical land conflict. And there are states which are relatively easier or unconstrained when it comes to renewable energy potential, and there are others which are not. I reached out to Dr. Arunabha Ghosh, CEO of the CEEW, and I began by asking him what were the key takeaways from this report.
So, Govind, first of all, thanks for having me on your program. As you said, we've got about 150 gigawatts of solar and wind and other renewable energy resources. These have traditionally been deployed where, the land is more easily available, in open desert areas or, along the coast for wind power and so forth. So our analysis was more to look at, what kind of constraints will we face as we scale up the renewable energy requirements to move towards our net zero targets. So right now, the way we've done this analysis is we've looked at what's the unconstrained potential. And the unconstrained potential in India is over 24,000 gigawatts of RE capacity, renewables capacity that can be deployed. But life is not unconstrained. So we start looking at various different aspects. First, we look at land. When you run out of desert areas, etc., in more population concentrated areas. Then you look at where you have the maximum amount of sunshine or the high intensity winds. So then you move into lower solar radiation, lower wind areas. Then you look at also population concentrations and the potential land related conflicts, because there are alternative uses to the land. Often what is described as wasteland is never really wasteland. There's some work that the land is being put to. Then we get into other types of climate risk. Is that area going to be exposed to storm surges or sudden or droughts where you need water for your green hydrogen projects? We even look at seismic zones. So the more and more areas that you deploy, is there a seismic threat? So once you look at all of these different parameters, and we've done it in a very granular way, we've converted the entire landmass of India into a 5 kilometer by 5 kilometer grid, what are called rasters. So that gives you a very, very detailed analysis of where you have the potential and how do you get there. And based on that kind of constrained analysis, we still see that India has the potential for well over 7,000 gigawatts of renewables capacity. And that is enough to meet our net zero goals. So really what we did was, what does India need for net zero? We had done a previous study on this. And then we asked ourselves, okay, if these are the goals, how do we get there? Do we have the land and the sun and the wind and the water to deliver? And the answer is, at least in potential, yes.
So incrementally, where would, as projections stand, how would this be split between, let's say, solar and hydro and wind, among others?
Yeah, the bulk of this will still come from solar and then comes wind. So I would say India, 20,000 gigawatts of solar potential is there. But then we also face, constraints of high seasonality of solar, etc. But even then, the bulk of it is going to be solar, followed by wind. We've got about onshore wind potential of about 1,800 gigawatts. But again, looking at constraints where it's located in croplands or rangelands, etc., we've got about 2,400 gigawatts of offshore wind capacity, but only 30% of that is within waters that's less than 500 meters deep. So it will really, the way we see it is at least up to 1,500 gigawatts of solar wind combined. We don't see so many constraints kicking in. So that's 10 times more capacity than what we have today. What we can do is then start looking at, are there ways to still keep scaling up beyond that 1,500 gigawatt level, up to say the 7,000 gigawatt level, by rooftop, using agro photovoltaics, using horticulture farmlands to also combine with renewable energy projects, to do wind and solar hybrid projects where you get higher efficiencies and so forth.
Right. So as people, including companies, plan their future renewable energy projects, one of the things that your study says is that there are clearly states, for example, Rajasthan, Madhya Pradesh, Maharashtra, which have higher renewable energy potential than other states. Is there an approach here that should be different or ought to be different from what it was earlier?
I think one of the things that the study reveals is a little bit of a surprise. I mean, we always knew Rajasthan had huge potential. Even now, our analysis shows it has the maximum potential for low-cost solar generation over 6,000 gigawatts. But Madhya Pradesh is a surprise a little bit. It's nearly 3,000 gigawatts. Karnataka shows up as offering considerable wind potential of nearly 300 gigawatts. Odisha jumps out as another unlikely state that has very high RE potential. So once we internalize that there are these surprises, you also realize that the renewable energy story and the energy transition story for India can actually be much more distributed in terms of its benefits than maybe the traditional energy approach. You have just a few states where you dig up the coal, even fewer places where you can dig up oil and gas. So you can have a more balanced economic development approach. You can bring the energy transition closer to people. Also, from a policy perspective, I think it gives these states an outlook that it's not just the energy transition, but also how the energy transition benefits their own development trajectories. Because that power is not going to be all consumed within their own region. So then there's going to be more of the trading of the power from one part of the country to another, which is why I said the grid planning is important. But that also then creates new power markets of the future, do more spot trading rather than the long-term contracts that have been traditionally the approach in our power markets. So there's going to be a lot more dynamism in the power markets. There's going to be, therefore, a need for a different approach towards power regulation, how tariffs are set, but also how tariffs are determined, how you use this variability of our solar and wind, but also the opportunity to draw on it from different parts of the country to design the load curves, to create incentives for when households or factories or shops and commercial establishments, how they use power at what times of the day. So it really opens up a lot more opportunity in what we imagine the power system to look like in future than what it has been in the past.
Your report also touches on green hydrogen. So why is green hydrogen defined by location why is it defined by location, or what is going to define its production and distribution?
So firstly, for your viewers and listeners, green hydrogen basically uses clean energy to split water into into hydrogen and oxygen. And then that hydrogen can serve as an industrial fuel. Therefore, that clean energy you can get from wind and solar or a hybrid of the two. But you also therefore need the water to actually split, which is why it's not just the land needed for the renewable energy projects, but also the water availability. We estimate that our wind and solar hybrid potential can produce up to 80 million tons of green hydrogen production in India. About 56 million tons, mostly in Western Southern India, can be produced in areas that do not face water-related issues. Now, put this in context. We currently use about 5.5 million tons of hydrogen. Our green hydrogen mission has a target of 5 million tons by 2030. So having the potential of 80 million tons, of which 56 million tons can be produced in areas which do not face significant water-related issues, means that we've already taken into account agriculture, industry, household needs for the water in those areas. That actually, again, tells us that we can actually genuinely become a major superpower in the green hydrogen ecosystem, right? But again, to do that, you've got to site the projects correctly. You got to then use your tenders to encourage siting in those areas. Accordingly, you get the best revealed prices. And where you still have constraints, then you have the incentive to establish the water storage infrastructure, which has other co-benefits for a water-constrained or water-stressed region. So I think this also explains why both as an industrial fuel, as a driver of new renewables growth, but also a driver of a way to optimize not just the land, but also the water resources, can be a way in which this study can help to guide the policy makers and development trajectories that different states take on.
Arunabha, it's been a pleasure talking to you. Thank you so much for joining me.
Thank you, Govind.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.